Although the industry was expecting a rate cut from the Reserve Bank of India in its latest monetary policy review, the central bank has held all the key policy rates constant. Consequently, the repo rate remains at 8%, the reverse repo rate at 7%, and the cash reserve ratio at 4%. The RBI has given strong rationale for doing what it has done. One, it says is that although the inflation has come down below its long-term or medium-term trajectory that it has set for in January 2016 of 6%, there are upside risks to inflation. The key risks include the monsoon playing prompt, the northeast monsoon especially, and they're stoking inflation yet again. The crude oil prices, which have fallen by more than $30 in the past few weeks, coming back more aggressively, and the fiscal deficit target of the government, whether it would be met or not. These are the key aspects on which the RBI has hinged the current policy review. But it has said if the inflation holds at the current levels, there is a strong case for monetary policy action sometime early next year, which is what needs to be looked at and which is the key takeaway from this policy. Also, the Reserve Bank of India has said that the new monetary policy framework as suggested by the Urjit Patel committee report as well as by several other committees will be in place soon, and the government has signaled that it is quite comfortable with the 4% target set therein with a plus or minus error of 2%. So RBI is clearly directing inflation or guiding inflation targets along its long-term view, which it says is very critical if sustainable growth has to be achieved. It has also urged the industry to stay with it as it is trying to deliver the economy into the new orbit or into the new regime. And therefore, inflation is going to be the key for RBI going forward too, which is how this new policy or this latest policy needs to be looked at.